Turn on my video and see if that all works, hopefully. All right. Well, thank you for showing up today. I'm actually trying an experiment with a timer here because there is so much to talk about. We are going to only spend 50 minutes, but we can go longer if you want, talking about income tax policies, or actually just taxing policies, because two of these are not income based, but they're consumption based. But it's still part of what we want to talk about. So the problem with talking about taxes, it's like talking about debt. Everybody's got an opinion, and nobody wants to go through the process of needing to pay them. So how do we make this better? People have been looking at this for a while. The fair tax was introduced bipartisanly. I think it was in 1999, if I got my research right. And now it's been reintroduced every year into Congress, every 2 years, every new Congress. But our support now seems to be only on the Republican side. So it's become one of the partisan issues. Y'all remember back to January, it took a little bit to get a new Speaker of the House in place. This was one of the reasons, is that that conservative bloc of Republicans wanted the fair tax to come out of committee and be put up for a vote. And the other thing I found out is that they also wanted term limits to be brought out and put up for a vote. So those kind of how that ended up impacting our January tax, or January political structure, which is normally a fairly easy thing to get done, is to have the new Speaker of the House put in place. All right. So we will have questions and answer time at the end, and I'll try to throw things in there. And if we run out of time, if I run out of material, I've got lots of more things I can talk about along the lines of taxes. So, fair tax, the value-added tax, which we don't have in this country. The flat income tax, again, not something we have, and I'll talk more about that. Our current tax system here in the U.S., which some of us still need to file for the year. And then I'll do a brief overview and some pros and cons, and then highlight the differences. Any luck, that'll work out. So, what we're trying to do with the fair tax, so it was introduced in '99, it's been reintroduced in every Congress, that means every 2 years. The sponsorship has changed. Originally it had 4 sponsors, now it has more sponsors, but they're all on the Republican side of the House. So that kind of makes a change. So what is it? It is a consumption-based sales tax at the federal level. We're here in Tennessee, so we're used to not having an income tax, right? We pay property taxes and we pay sales taxes. And I'm not sure, most services still are not taxed here, right? It's mostly just goods that are taxed. Okay, so my timer is not working, so, all right. Oh, it's a different timer, okay. And what we have seen during the pandemic for the last 3 years, states that rely mostly on sales tax have had a more steady, stronger income base than states that also rely on income taxes. Because incomes have gone down during the pandemic, depending on what jobs we're talking about, but people still needed to consume and buy things, so that kept the revenues coming into the state and the cities that use sales tax as their principal way of generating revenue. Now there's a lot of question or concern about this. It's like, okay, what is inclusive versus exclusive tax rate? So we say, or the fair tax people say, 23% inclusive. And then all the people that don't like fair tax will come back and say, oh no, you lied, it's actually 30%. And yes, it is. It's actually 30%. If you buy something for $100 and you add the tax to it, it's going to be $130. If you take the $30 divided by $130, you're going to end up with a 23% inclusive tax rate. So that's kind of how it works. I remember way back in college, it was a marketing class, and we were talking about gross profits and profits, and how do you mark inventory? You know, is it inclusive or exclusive to get to the retail price? So you buy something as a wholesaler for $100 and you retail it for $200. So is that a 50% markup or is that a 100% markup? So that was the last time I dealt with this many years ago in college. Now, I say this is a quasi-progressive system because there is a prebate or a rebate based on your family size, based on the poverty level in the geographical area that you live. So if you live in Alaska or Hawaii, the poverty level is higher, so you get a prebate that's higher. This prebate is based on the number of people in your family. Who's going to pay that out? As the law is written, and it's 132 pages of code right now. So think about that. You know, when you turn code into regulation, it does expand a little bit because of the nuances. So that means, we figure if you are making poverty level or up to the poverty level, everybody will get a prebate if they register for it. It's totally voluntary. You need to have a valid Social Security number and legally be in the country to receive it. You'll get that money every month. It'll be distributed by the Social Security Administration as a debit card or deposit to your checking account. And that's what kind of makes this quasi-progressive. The assumption is the more money you spend, then the more money you're going to pay in tax, but you have this little bit of prebate that reduces overall the amount of tax you pay as a percentage. So it will always, because that prebate goes to everybody, it will always be a lesser percent than the whole 23%. Does that make sense? It's a different, there are some nuances to this thing that are a little bit confusing. So it tax goods and services only the first time they are sold to the end consumer. So if you buy a used car, and again, nuance, this is after the change in the law so that the fair tax would become the law of the land. So if you bought a new car, you would pay your 23 inclusive 30% inclusive tax on that car as the first purchaser. Then you turn around and resell that car to your neighbor a month, a year, 2 years later. There would be no tax implication for you in that resale. Same with a house that you bought, anything that you bought, so long as you're not in the business of selling, reselling, retailing. So now one of the things about the fair tax is who takes care of all this paperwork? Well, where you purchase your items, they will be doing the collection. They'll also get 0.25% up to $200 for doing that collection for the state or the federal government. And then you'll have what that does, so you get money going to the state, you get money going to the feds, probably money continuing going to the city. As long as they're a conforming state or conforming city, then they can collect the tax for the federal government, and it will go, they will receive 0.25% as an administrative fee. Now, what about the states that don't have a sales tax? They can contract with other states, probably near them, to manage that collection for them. Now, they'll still, the businesses will still have to register to become a tax collection and no taxpayer when they're buying things. And there's two ways of doing that. So for intermediary resale like CPA firms, we buy a lot of goods and supplies to keep our business running, we wouldn't be paying tax on that. But then when someone pays us, federal, state, local, federal, independent person, they would be paying the tax then. Now, if it's a business that's paying for our services, again, they wouldn't pay so long as they have a retail stream where they'd be collecting the money. The main thing about all this confusion is it's not on the individual. It's on the businesses. There's also a way that banks need to get involved in this because they need to pay tax or they need to collect tax from you when you're making an interest payment, not the principal, just like today's system. And if they're not paying you enough, this is interesting, I saw, if they're not paying you a high enough return on your money that you have invested with them, then they have to pay a tax on the extra profit that they're making because they're not paying you enough. This is really kind of interesting. What this does, it eliminates payroll and inheritance taxes, gift taxes, and so that's where we'll talk more later about the cost of payroll taxes. That's embedded in everything we produce. It's kind of where that 23% comes from as well, because our embedded payroll taxes are around 22%. The other reason for the 23% is that replaces what we currently collect tax-wise. So it makes it pretty easy there. So this whole thing is, the fair tax is supposed to be tax revenue neutral to compare it to our current U.S. income tax system. The other two, I'm not really sure about that. Now, everybody gets concerned about, well, what about Social Security? How are we going to fund Social Security? Because right now, Social Security is tied to the wages you make. You pay a portion of it, and your employer pays a portion of it, up to the $1,660 some odd $1,000. Then Social Security is no longer taken out of your wages. Medicare still is. So what a fair tax does in the statute is it has percentages that are set up. 65% of all the revenue collected will go to the general fund, and then the other 35%, the most of it will go to Social Security, and a little bit will go to the Medicare, the medical insurance programs that we have at the time. So that's kind of what the fair tax is. Oh, because most of you here are involved in government, there's two things I want to throw in there. Because government services are not sold to the public, the wages that the government pays to their employees will have that 23% tax imposed on them. And that comes out of the government. So they'll be paying that extra 23% tax on wages that are paid. Now there's two caveats to that. Government enterprise funds, i.e. you're providing a service like utilities, sewer, park and rec fees, if you actually charge a fee for something, the people that work for those entities would not have the government would not be paying taxes on their wages, because they would be collecting taxes when they sell those services to the public. Now, one of the things that the fair tax does to encourage education, tuition, and government wages in the education sector that directly tie to education benefits are not taxed as well. So it does encourage training and education. Anything else? Okay, I think that's it. Now, what is the value-added tax? It is also a consumption tax. In other words, it is paid as goods move through the production process, or what I call the procure-to-sale process. So when we're talking about the fair tax, we're talking about collecting the tax only at the end of the production facility process. So with the value-added tax, the selling entity pays tax to the government on what it purchased or the value it added. So if it just purchased raw materials for $100, and whatever the tax rate is set by the government, it would pay 100. If it's 15%, they'd pay $15 to the government. That's just the seller of the raw materials. Now the manufacturer that takes the raw materials and adds value to it, say they've added $10, I'm trying to keep it simple, $10 of value to it, then at the end of that process, and they sold it now to the wholesaler for $110, they would then be collecting from the wholesaler $110. They'd get credit for what they've already paid in, and only now $2 more would be going to the federal government, going to the government. Or 10% now, $1, sorry about that. Or 15, whatever the percent is. Then when it goes to final retail, and it's sold for $150, and did I say 15 or 10%? Well, we're going to use 10% because, I want to keep math simple. This isn't the CPAs. So it gets to the retail, it's sold to the consumer. The consumer, it will be sold at, let's see, what's 10% of 100? It'll be sold to you at $165, period. It's not put on the receipt that, oh, by the way, $15 of that is going to the government. Now the retailer collects that $15, and the portion of it that hasn't already been paid through this value-added chain of events would go to the government, and the rest would be credits to the retailer who purchased at wholesale. So he's not paying the whole $15. He's only paying the incremental difference between what he already paid taxes and what he collected, another $2 or $3 per item. How is this kept track of? It's called, normally they use an invoice method of tracking, so that these taxes have to be identified on every invoice as it goes through the procure to sale process. And that's how it's kept track of. You think that might cause, well, it might be good for us accountants, because you think the businesses are going to have to hire more accountants, file more paperwork, get more accounts with the government, have a special account, bank account probably, that they have to put the money into. Then they have to file reports at the end of the month usually. So it's very complicated. I think it's more complicated than a fair tax process. And normally, so that's all I've explained. Did I hit all these things, right? And then there's special rules for import and export, because they're trying not to hurt their exporters. One of the things that we have in our current system, because of payroll taxes, whenever our country exports something, that cost of payroll is embedded in the cost of the export. So when a foreign country exports to us, they normally get a full credit, because it's a value-added tax is a destination tax. So if it leaves their country and goes to our country or another country, it leaves at tax-free. So that gives the countries that use this value-added tax a price advantage over our country when we're trying to export items to another country, because we can't get rid of certain things like the payroll taxes. Any questions on value-added tax? Yes?
I would say value-added tax is used in a lot of countries overall already, right? And
correct.
Is it used on top of an income tax? Or
yes. Yes. Normally, and that's when I get to the disadvantage slides, that's the disadvantage of the value-added tax. It has, nowhere that I know of has it replaced an income tax. So not only do you have individuals filing income taxes, you also have companies filing the value-added invoice paperwork. And you have auditors going out and checking all these companies to make sure they have the invoices that appropriately account for the taxes, so that the government does get their full share.
How many countries, any idea, Europe has
Yes.
quite a few European countries use this, right?
Yes. Hang on a second. I think it's somewhere around 99. as of 2018, 174 of the 193 countries with full UN membership employ a value-added tax.
So most of the UN.
Yes, we are definitely an outlier because we don't. And then the tax rate is anywhere from 1% up to 30%. So it's very, like when we go to Europe and we buy something, there's a way for us to get our value-added tax that we paid back when we hit customs. Actually, there's a private company that helps you with this. That takes $15 of whatever you were getting back. So one year I bought my wife some nice pearls in Spain, I think it was. And so we got like $30 back of the $45 that we paid for the value-added tax. Yes, sir.
So is the value-added tax really a replacement on business income tax? Like, would they still file like an 1120 or something like that?
No, I think that, no, because remember, we've got this big issue, and our country signed on to it, of a minimum corporate tax of 15%, with very few exceptions to that. So, yeah, you got personal taxes, you have corporate taxes, you have value-added taxes in most countries. Yeah. And the other thing about, so, with the value-added tax, when you go into a store, in Europe in particular, that's where I'm most familiar with it. You see the price, 150 euros. It doesn't tell you how much of that, I think it's around 17% in Europe usually, of that is your value-added tax. You just know you're going to go to the cash register, you're going to give them 150 euros, and that's the end of it. You don't find out what that percent is unless you're going to that customs when you're clearing, you're leaving the country going, hey, I'm taking this back home. How much was the percentage? So one of the stipulations in the law for the, if it's ever passed, okay, for the fair tax, your retailer might say $100 is your price, but when you, and not include the tax, but when you get your receipt at the register, it's going to say 23%, $77. Right, $77 is what you paid, $23 is what's going to Uncle Sam, and then whatever, with us, another 9% is going to go to the Uncle, what do we call in Tennessee? Uncle Tennessee? It's going to go to Tennessee. So you'll actually see that on the receipt, like we do when we buy something anywhere. We see the price, tip, tax, total. So in Europe and other countries that value-added tax, you normally don't see all of that. And like I said, if you're taking it out of country, there's no tax on it. All right, now, what is a flat income tax? Yeah. So it usually starts as a single rate with very few, if any, deductions, and there should be no credits. All your income still has to be reported to IRS, so you still have your payroll income, you're still going to have your payroll taxes, which is regressive, by the way, because of that Social Security cutoff. Your employment taxes are the most regressive taxes we have in this country. So you still have to pay your regressive employment taxes. You're going to start with a flat tax, which would be a certain percentage. And I don't know what percentage we would need to operate in this country to replace our current system. Probably 25–30%, but people don't talk about that when they talk about the simplicity of the flat income tax. They talk more about that the fact that it's flat and make it simple. And maybe we'll get to the point where, because there's no deductions and no credits, and we could actually have kind of a simple, like we do with the 990 nonprofit postcard return. You might be able to just do a postcard return with IRS, because they know everything already about you, and there's nothing you can say or do about it. So now, what does that? That kind of goes to this. All right, well, what is the fair amount for people to pay for government services? And then, are we using taxes, revenue in this country to redistribute wealth? Or just pay for services that we receive? So that's kind of one of the questions that everybody has to sit down and ask themselves. You know, is it fair for a billionaire to pay 25% of his income in taxes? And is it fair for a minimum wage worker to pay 25% of their wages into taxes? Who uses the most benefits? How do we equitably pay for things? Tax forms still need to be filed, so you have not reduced bureaucracy one iota. I don't know if any of you have ever read the Paperwork Reduction Act. You know, it tells you on your tax forms how long it's supposed to take you to complete them, what information you need, and all that good stuff. So this doesn't eliminate any of that. It might make it simpler because you don't have the deductions, but we'll talk more about that when we get to our glorious current tax system, which I think is the next slide. So what about our current U.S. income tax system? It is progressive as it's designed. However, you know, Warren Buffett came out, and he's kind of rich, he's kind of up there in money a few years ago, and he was talking about the percent of his income that goes to taxes versus the percent of his secretary's income that goes to taxes. His percent was lower than his secretary, and I'm sure he pays well, but I don't think he pays that great. By the way, I just saw yesterday's news is Berkshire Hathaway now is the majority stockholder for Pilot and Flying J up here off of the freeway. So they have, he likes the energy investments for Warren Buffett. So one of the things that we have that a flat tax theoretically wouldn't have is we have a lower tax rate for capital gains. Again, why are we doing that? Because we're trying to keep money in the investment cycle. You go to the fair tax, there is no tax on the investment cycle. You get to keep investing. You get to invest your money forever without paying tax on it until you actually bring it into your household and consume, buy something that's consumable by your household. We currently have business losses and carry forwards, which is probably a good thing, but it adds complexity to how our forms are filed and what needs to be filed. We have home mortgage deductions. Now, one of the things with home mortgage deductions, as you'll see later, only 20% of tax filers or payers in our country take advantage of the home mortgage deduction. Now, there's a lot more home owners than that, but we've kept raising the standard deduction so high that not everybody gets the specific benefit of a mortgage deduction. And again, that is mostly a benefit for the more wealthy of our citizens. We have education deductions or credits, which is built into our system. We use credits and deductions to favor certain industries or types of energy that we want to produce. We use credits to promulgate having families and the size of the families. We have our energy efficiency credits, which I think is a good thing because I'm getting ready to make a bunch of energy efficiency improvements to our home. And I was glad to see that they came out and said, hey, for 10 years now, we've locked this in. You will get your credit for a higher efficiency heat pump, the extra insulation you add, the higher efficient windows that you add. So that was good. I mean, I'm glad to see that. Dependent care really doesn't affect me anymore. I don't have any dependents to care for. So the big thing about our current tax system, it's complex. Gosh darn it. When I first started as an accountant, not even CPA, I took a test for beneficial finance right after I graduated college in December of 1982 to do tax returns for them. I ended up not doing that, but I did take the test. I had to do it all by hand, just like I had to take the CPA exam in '84 all by hand. No computers, but I didn't need a computer to figure out the different limitations that we had in taxes in that would have been tax year '82. It was pretty simple, pretty straightforward. There was income averaging. I did have to deal with that. That was something that we did a lot back then. But I was able to score a really high score on that test that I took. So I would have gotten to keep a third of whatever beneficial finance charged their customers as they came in to do taxes. I need to finish my taxes this year, and there is no way I would even try to do that by hand. I mean, I skipped through a lot of stuff, but then I've got 3 pages on my computer screen of credits that I have to know about in order to take them or not take them. So anyway, our current tax system, the other thing about our current tax system, every week that Congress is in session, somebody is trying to, again, amend our current tax code. Normally that's driven by special interest because they want something not taxed, or they want a credit for something that they want to do that benefits the rest of us. That's where it goes into, it doesn't matter which tax system we're looking at. There's winners and there's losers, and how do we pick winners and losers as a political body, as a group of people? It goes back to what I talked about. What's a fair share that somebody should be paying? Should we be using taxes to redistribute income for people? Okay. So, some pros and cons. I think I'm about halfway through our time. Yep. Oop. I only have 20 minutes left. Aren't you guys lucky? Okay, so, and I've kind of thrown these pros and cons in as we've talked. So, again, if you have questions, please, by all means. So I say it's quasi-progressive because the progressiveness assumes you're going to spend, as the more money you make, you're going to spend more. And you have to have a Social Security number to be able to invest. There's no payroll, inheritance, or gift taxes. There's no end-of-year paperwork to file as an individual. You will still have to file with Social Security, because that was another question my son had. It's like, okay, well, if we do this fair tax or collecting sales tax, then how do we connect Social Security back to the person's income during the year? Well, that's simple. You still have to file as an employer or self-employed a report probably at the end of the year with Social Security saying how much my employees made or I made. I took out of the business. And here's something that's going to be a real change, because right now you can report. I know my son's a bartender in Northern Virginia, and $30,000 of his wages is tip income. Well, as the tax law is written, fair tax is written, if we went to fair tax, you'd only get credit for up to $5,000 of tip revenue. But just like I mentioned with our current tax system, guess what? Somebody's going to introduce a bill in Congress to change this aspect or that aspect of the fair tax or any tax system that we have in place to correct some of those things. But again, remember the idea though, the more exceptions you have to something like the fair tax, the higher that tax rate is going to have to be to still be able to capture the same amount of revenue. Let's see, what else do we have here? Oh, I like this one. So, most of you don't know, but in my younger days, I was also a registered financial advisor. Meaning, and I did that through Prudential, so meaning I was a fancy insurance salesman and I could also sell IRAs. Not the best job in the world, not the worst. But look at how much money. And when I grew up in public accounting back in the 80s, I mean, we had folks knocking on our door as a CPA firm saying, hey, I've got this great tax shelter for your clients. And even now, you know, that's been eliminated by law. But we still have a lot of planning that goes around retirement investment so that you get that deduction right away. So it's not taxed right away. That all goes away. If you don't spend your money, it's not taxed. It's just as simple as that. You can leave it in the investment world as long as you want to, and it's not taxed with fair tax. And I'm talking about fair tax. Yeah. All right. Congress right now is out on what they call an Easter break or spring break, because, you know, we can't have holidays associated with religious holidays associated with our politics right now. So Congress is out on spring break. If they came back in 2 weeks and they went ahead and passed and approved the fair tax, it wouldn't become effective until January 2025. And then IRS would have 3 more years after that to wrap up all their audits and criminal prosecution, even when it's not. But that's going to be extended as time, you know, because when you're thinking about this, the fair tax is just an act of law by Congress. So it can be extended, it can be amended, it can be changed. There's also one provision in the fair tax, if it's voted into office, is that the 16th Amendment is supposed to be repealed. Remember Prohibition? It was repealed. Well, the 16th Amendment allowed the United States federal government to tax income, because before that, Congress tried it, Supreme Court said no, there's no constitutional provision for taxing income. You can only tax duties and customs, things coming in and out, and sales. Can't tax individual incomes. Therefore, we needed the 16th Amendment. Now, when the 16th Amendment was being proposed, this income tax was not going to affect any of you here at the table. We are only going to tax high earnings individuals at, I think it was 2 or 3% a year. And they file that at the end of the year, and they write a check at the end of the year, and that's the end of it. Is that still happening today? Are you all sitting there writing a 2 to 3% check of your net income to IRS at the end of the year? No, there's a few things that happened. We had Social Security enacted. We also had payroll withholdings enacted. Because as we went through the New Deal in the war and other necessities of revenue, we had to increase our influx of cash into the federal government. And the only way we can do that without a revolt is if you're not seeing it every time you got paid. So that's what happened, and that's how we ended up with the withholding system that we currently have. So, what happens if the 16th Amendment is not repealed and ratified by the states? After 7 years, the fair tax goes away, and we go back to our current United States income tax code. I don't know who wants to, so the idea is that once you know about it, once you're living under it, you're not going to want to go back to the previous way. Again, that's all, it happens with individuals telling Congress, this is what I want, I don't want this, and we have to make change at the voter level. All right, so those are the pros. What are some of the cons? We're all used to our deductions and our credits. What are we going to do? I like having my own interest deduction. I like having, when I was looking at education stuff, I like having my education credits for my children when they're under my house. The other problem is this change does not balance the budget. This change, the only thing the fair tax is supposed to do is bring in the same approximate revenue as we get now. And the proponents of the fair tax aren't going off into, as President Bush used to call them voodoo economics. They're not going to say, oh, this is going to improve the economy so much that our revenues are going to grow. It's the way it's structured mathematically is supposed to just replace the income that we currently collect, which is changing every year anyway. So. Yes, sir.
Yeah, there's one thing I didn't see on the cons on the fair tax, and I'm curious what your opinion is on this, but what would be the impact on actual consumption in the economy? Because once you impose a 30% tax on everything, we're going to assume that people's personal spending is going to change, which is going to reduce consumption.
Well, you always, so one of the things that's going to be taxed that isn't taxed now, well, and that's kind of you're getting into really services are going to be taxed that aren't taxed now. You think about it now, so the big one, which I find kind of interesting, is medical. If you are paying tax on your, in other words, when you pay for your medical insurance, you are paying the tax at that point to the insurance company to get covered. Then when they pay a medical bill for you, that is not taxed. Now, if you still have to do a $30 or $20 copay when you go visit your doctor, that would be taxed. So it's the whole idea is you're broadening the tax base to collect that extra money. One of the issues, which is one that I didn't realize until I did some research on it, say if you are a billionaire and you're buying a big asset for your personal use, you normally are borrowing against your wealth to do that. You normally don't take part of your wealth and bring it into the income stream to buy this big asset. Usually they refer to yachts and planes and things like that. So those purchases never get taxed at the federal level because you haven't brought any money out of your holdings. You've only borrowed against your holdings, and therefore those things aren't taxed. Now, if you were to buy those things, because people like having stuff still, so if you were to buy that under fair tax, it doesn't matter where your money comes from. If you borrowed money or you pulled it out of your investments, once you take delivery of this yacht, this private plane, I'd say private plane, not a business plane, you're going to have to pay the 30% tax on it then. So it just depends on who wants to buy what. I look at my spending and it probably wouldn't change much, although I might look again at used cars. I just have not been a very good used car buyer. I, for some reason, when I buy a used car, can pick out the lemon, and that does not do me well. So I buy new cars and I keep them until they are no longer economically viable to keep. Does that help any? Okay. And you have food now, so that improves it as well. Pros and cons of the value-added tax. Pros, it captures your consumption. Again, at the federal system, revenue is paid to the government throughout the sales process, so it keeps trickling in. That's just a big paperwork problem. It does not eliminate the income tax. Most countries use both. Requires additional accounting staff to track, and probably also at the federal level too, or the taxing authority level as well. And yeah, because you're going to have auditors go out and make sure, and they'll probably use us lucky CPAs. They'll probably contract that out just like they do everything else. So it might be good for us. And it's indirect. Excuse me. It's an indirect tax and does not show up on sales receipts. It's just that 150. It's hidden in there usually. And then you got the special rules for importing and exporting goods. Questions? Pros and cons of the flat income tax. It simplifies your IRS filing forms. Again, like I said, you might actually be able to get to a point where we're just doing postcards. And Congress can continually adjust the rates to achieve the goals they want to. However, you know, for the last 30, 40 years, Congress consistently has been adjusting rates down and increasing expenses. So that's, I don't know, is that really a pro? A flat tax is the most regressive tax system we have, meaning the less you make, the higher percent of your income goes to taxes because of the payroll taxes still being there. Personal financial information is still collected. Those of you that are big privacy folks, I don't know. You can actually look me up by name on Google and you can see what my last salary was with the federal government. It is still out there. I did that last week. I was like, ugh. I really don't like that information being out there. But that's a separate law, trying to get Congress to report things. Oh yeah. Interest and dividends are taxed. Again, that can be handled at the investment firm or the bank that just send your the percent of your earnings off to the government. So what happens then? You don't get the full compounding of it. So, do we still have the retirement deduction in the flat tax? Who knows? Now it depends on how it's structured. And the big thing about the flat tax, so the countries that have tried a flat tax, it has not stayed flat for more than about 10 years. And again, you can look it up in Wikipedia, or you can take a look at my stuff. Pros and cons of our system. We're familiar with it. We know what it is. You know, it's just kind of like change is hard. It's with proper advice, accounting, legal, the system is fairly easy to manipulate. You know, the people that support our politicians want to make sure that their political donations don't go to waste and they can still get the benefits that they want. And it, you know, whenever we see a new tax law change, those of us that work in the industry or the field kind of go, whoo, all right, I got some more job security for another year or two until this all gets figured out, and Congress will change it again anyway. So the system's not as progressive as most people think or want. Extremely confusing and time consuming to complete all the forms that you're required to complete as an individual, your employer is required to complete as an employer. And again, the laws are often manipulated to benefit special interests. Like I said earlier, most of those requested changes to our current Internal Revenue Code are done because of special interests. All right, so kind of here's the differences. I didn't change this, but the fair tax is quasi-progressive. Only businesses and employers need to file reports and pay, because the consumer is just built in. It's part of your point of sale. You don't have to worry about it unless you're bringing in, well, and even if you're bringing in goods from other countries, there's customs to help you. Always have been. Not your current excise taxes and duties they don't get changed. Anything that ATF currently does, they will continue to do. And there'll be another excise or a branch of the Treasury that will be established, as well as one that manages anything that comes in for the fair tax. So the value added tax, it's flat, on the income or on the sales, but it's normally just one of many revenue sources for the government. Businesses collect reports and file the returns, and it's pretty much hidden from the consumer. I mean, there are people that are interested in what how much of my shoe actually went to the government versus to what was in my feet. The flat income tax is the most progressive tax system that we can have. And I kind of think our current tax system is a mess. I'm not crazy about using it. And lastly, comments or questions, and guess what? I am right at 50 minutes, but we can go on as long as you all want. Okay, enjoy your meal. Thank you for your time.